tonight we're just going to keep on going. Someone had asked for a little bit more, I guess, elaboration on the estate concept, the concept of estates. So let me cover that because that is a confusing topic, and let's look at it from a slightly different angle. We kind of ended the night last night talking about it. So while the book, well, the chart I gave you gives you estates in two categories, inheritable and non-inheritable. Let's look at it this other way. Let's look at it a little differently. So estates in real estate, what are we talking about again? Estates just mean your rights of ownership, what you can do with it, what you can do with that property that you own. So there's four, I guess you could call four types, unofficial types. There's the one that's the best possible way. The best way you can own something is fee simple absolute. Why is that the best way? Because there are no conditions on it put upon you by the previous owner. Let me say it that way. Because while the previous owner might not have put any sort of rules about on it for you, like you have to keep using it in a certain way or you must not use it in a certain way, it's always going to have some kind of conditions, because those other conditions a property can have would include zoning laws, would include deed restrictions. Deed restrictions are not the same as estates. So I don't want you to confuse those two things either. There's lots of things that can tell you what you're allowed to do with your property. Even though you own it as fee simple absolute, you still have to follow the rules and laws. And zoning laws are included. Deed restrictions are private land use controls that would still apply. The thing about estates is, what are the rules given to you by the previous owner that you bought it from, the seller you bought it from, if any? And when it comes to fee simple absolute, there aren't any. Previous owner said, I don't care what you do with it. I'm not going to be that way. Do with it what you want. Just pay me the money I want, right? So that's the best way. Then we have the category of things with conditions, like rules. And those are pretty much fee simple defeasible. Don't worry about the crazy word fee simple. It's just a word. Doesn't even really matter what it means. Like in music, don't worry, it's not the key of D sharp. Any musicians, doesn't matter that you have that sharp, that annoying sharp, D, A, C, D sharp. It's all just a name of a thing, but all the stuff still works the same. So fee simple defeasible just means there are some sorts of conditions involved. There's either must keep using it a certain way, which is determinable. Fee simple determinable. So if your deed says that you own this thing as fee simple determinable, then it means that according to the rules that they're going to tell you, you've got to keep using that property in the way they say. It might be that you must keep using it as farmland. Or it could say you're not allowed to use it in a certain way, in which case that would be a fee simple defeasible subject to a condition subsequent. So all of this fee simple defeasible involves conditions. Then we talked about life estates. Life estates pretty much just mean you have another kind of condition, but this time it's a lifespan. You can own it for somebody's lifespan. It's either going to be yours if you're the one who bought it as a life estate. I'll just say yours. Or another's, in which case that would be called fee simple. Sorry, that would be called pour out V, for the life of another. And then the last thing we talked about with regard to estates were marital rights. Your rights as a spouse depend upon how long you were married to that person. Marital rights pretty much just this is just if your spouse died and they tried to either cut you out of the will or they left no will, it doesn't mean you're out just because your name is not on the deed. If you were married and they owned property with their name on the deed, they died because of the marital rights under this estates topic we're talking about, you're not stranded. You're not screwed over, right? It's going to depend on how long you were married, number of years equals a certain percentage of ownership or certain rights to that property once your spouse has died. If they either cut you out altogether or left no will. That's all the marital rights even matters for, is if you're left out of the will or if there is no will. I don't know if that helps, but looking at it kind of in a different format than the chart might be useful. But again, this is just talking about what kind of rights or conditions or ownership did you buy from that seller. That's what estates are. If you still have any trouble with it, you just let me know, and I'll be glad to have a phone call or one-on-one phone call or text or email. I could do a video, a custom video about the topic too. So just reach out. And then don't forget you can direct message me in the chat anytime tonight or anytime. It's fine too. Okay. All right. Somebody type answer in the chat for me. I'm checking something to see if this chat's working properly. Give me a topic that you might want to cover tonight. Let me see if I'm getting things in the chat. Yeah, we're definitely doing math. Anybody have another one? Anybody have trouble leaving me something? Okay, good. Everything's coming to me directly. Okay, let me change it then. Now it's going to be different. Got it. I changed it back to, you just can't talk to each other individually. That's not allowed, turns out. So I can't let that option be available. But you can answer to everyone as a group and then to me, of course, directly. Perfect. That's what I need to know. Okay. Yep, math is on the agenda. The final is certainly available anytime. We'll go over those. Give me some numbers of the final that you'd like to talk about. And if you don't have any right now, then we'll put that off till after the first break. And between now and through the first break, come up with some numbers from the final that we can talk. National, state, either one, and we'll go over those. But speaking of math, let's go ahead and get that handled while we're fresh. All right. So on the final state portion, I took that this afternoon. They had an excise tax question. I think you all have that one okay. Okay, good. State exam, let me take a look at that. So excise tax, let me give you a sample problem. And I'm going to have to abbreviate. So let's see the sale price. Sorry. It's like my Apple Pencil ran out of ink. There we go. Sale price is $135,000. Nope. $135,300. The loan to value ratio is 90%. The appraised value was $131,000. But even though it appraised for less than the sale price, the buyer paid extra money and they actually did sell it for $135,300. So that was actually still the sale price. And then the interest rate that the buyer got was 6.5%. What was the excise tax on this transaction? Oh, yeah. I was looking at 39 on the state. Somebody asked to go over. I believe that's the big monster question. Yep. Yeah, it's a good one to go over. Okay, let's see here. So, excise tax, did I throw you? Did I confuse you with all the extra information? Excise tax is pretty simple. It's based on sale price. So, none of this matters. All that's just nonsense. I could have also talked about tax value. I probably should have thrown one of those in there, but that doesn't matter either. For excise tax, it is sales price divided by $500 and then rounded up to the next dollar. So 135, 300 divided by 500 is $270.60. But the government says, don't bring us that 60 cents. You round that up. We will take $271, please, and thank you. They will throw some stuff at you. So just be careful. Watch out for it. We good on that? $1 per 500. They might ask you an excise tax question without it being this kind of calculation, meaning they want to know the formula. So the way they could ask you an excise tax question without it being a calculation like this is they could say, what is the formula for determining excise tax? Tell me in the chat. What's that formula for determining excise tax? That's it. Just $1 per dollar of sales price for every $500. $1, let me say it that way. $1 for every $500 of sales price. Right? That's the best way to think of it. $1 per $500 of sales price. And it requires rounding up to the next dollar. That's it. That's excise tax. And what else? Make a note here. Somebody put in a few numbers. Another one that you're going to need to know is calculating good old discount points. How much does one discount point cost? Or what's the formula for calculating one discount point? What's the formula for it? You got it. 1% of the loan amount. Sorry, I'm making sure I have these number requests from the exam. 1% of the loan amount. Therefore, don't let them throw you off if the question has a bunch of numbers in there. They say the sales price was $318,000 and the loan to value is 85%. Well, you do need that number if all they give you is this information. Discount points is what we're doing. And then what else? It could say the tax value is $308,000. The buyer needs 2 discount points in order to get the loan. They're going to need to pay 2 discount points worth of upfront prepaid interest, also known as lender yield, right? Discount points equals lender yield equals prepaid interest. You could see it asked any of those ways. And you're going to know, oh, that just means discount points. They might even say that the investor wants 6% of a rate, but the lender is willing to do it for 5.5% if the borrower pays points. And then they would ask, how many points will that require? So that the investor's happy because the lender is going to charge the borrower 5.5% rate, but then the borrower's also going to put down a big chunk of money of prepaid interest, also called lender yield, also called discount points. So we'll do that when I kind of threw an extra problem in there on you. Let's finish this one first. Needs 2 discount points. What number do we need? Yeah, sorry. Somebody asked, how are you supposed to know what you got wrong? You're just going to have to ask me. They don't give you the answer key. I would say retake it, see if you get it right the next time if it shows up again, but definitely include that in what you want to ask me and we'll go over it here together. So first step for a discount point problem, need to know what do you calculate it on? And since it's a lender-based question, lender questions require the loan amount. And in this case, we don't have a loan amount. We're going to have to calculate it. They gave us what we need to do that with, though, 318 and a loan to value ratio. So 318 sales price times 85% means a loan amount of $270,300. We know our loan amount. The number of discount points we need is 2, which means 2%. 2% of the $270,300 would be $5,406 is what's required in the form of prepaid interest, also called discount points, also called lender yield. Let's do this thing I threw at you in another way, worded this other way. Cursor's not large enough. There we go. So this question on the right, we have the investor wants 6%. The investor is the one whose money is being borrowed. The lender's charging the borrower 5.5% if the borrower pays discount points to make up for the rest. The rest of what? The difference between the 6% the investor wants and the amount the lender's willing to let you base your payment on. We're talking about 0.5%. That's how much we need to buy the rate down. That's how many discount points need to be purchased. 0.5% worth. But don't let it confuse you how much a discount point costs versus how much it lowers the rate. We're talking about how much is the rate being affected here. And for every 1 discount point, the rate can be lowered 1/8%. How much is 1/8 in decimal form? Because I'm not going to ask you to convert fractions to decimals. That's not nice. 1 divided by 8 is 0.125. So just divide that 0.5% difference between what the investor wants and what the lender's willing to charge you for 30 years. Divide that by the 0.125. And that tells us that there are going to be 4 discount points needed to be purchased. Need to buy 4 discount points. And that might be the end of that question. Or they could also go ahead and give you the loan amount of, what if they say the loan amount is $427, and then they ask how much will those discount points cost? So you needed to figure out how many points required and then figure out how much do 4 points cost on a loan amount of $427. But you can do that now. $427 is the loan amount times 4%. If that borrower can come up with $17,080 to give to the lender at closing, in addition to their other stuff like closing costs and down payment, then that investor's happy because they're earning 6%. They got a chunk of it up front in the form of prepaid interest, and then they're going to get the rest based on monthly payments at 5.5%. That makes sense? So you're going to have to understand the difference in those 2 parts of a discount point problem. If they ask you how much will the discount points cost, that's just 1% of the loan amount. So how many discount points equals how many percent of the loan amount? If it's 8 discount points, that'd be 8% of the loan amount. Then they could also ask you, how much do 2 discount points lower the rate by? 2 discount points lower the rate. You don't need to even know any other details to answer that question. How much do 2 discount points lower the rate? Well, 1 discount point lowers it by 1/8%. So 2 discount points lowers it by 2 times that. If you don't like fractions, again, make it into a decimal by doing the 1 divided by 8 and just work with the decimal. 2 discount points are going to be 2 times this number. 0.25. You might recognize that as a quarter. You might recognize that as 1/4, 1/4, right? A quarter, like a piece of change quarter, 25 cents. We okay there? Looking at faces, looking for some visual feedback. Let me know if that's a problem for anybody. Direct message is fine. Okay, related to discount points in that it is another lender fee. Something else you could see is origination. So they might ask, what is the origination fee going to cost? So they would say, let's just make it simple. Loan amount is $414. The lender is charging an origination fee of 1.5%. How much will the buyer have to pay for the origination fee in dollars? 1.5% of 414, right? In this case, $6,210. All an origination fee is a sort of an administration fee, just the cost of doing business. Thank you for picking us to loan you money. Now pay us an origination fee, amongst other things. So that lender's making an origination fee from the borrower. They're going to maybe charge discount points. They're going to earn interest with every payment. They're also going to earn money when they sell the loan to the next person, the next bank, right, on the secondary market. There's all kinds of money flowing when it comes to loaning money on that lender side. The problem could also say it this way. They could say the origination fee is 1.5%, and the buyer also needs to buy 3 discount points and you could choose to do this a couple of different ways. You could calculate individually. 1.5% of the loan amount is what we just figured up. 3% of the loan amount is whatever that is. Or you could recognize that origination fee is 1.5% of the loan amount and discount points are 3% of the loan amount. So if they're asking for both of these things combined, then just do one calculation for that for 4.5% of the loan amount, right? 3 plus 1.5. And now you're done. Because that's all that matters. Because they specifically ask you how much will the buyer need to pay for both together. That's a very real possibility. In this case, $18,630. I think you're probably okay with that concept. Okay, let's take a look at that big question from the state final. It looked like this. One second. That's what I want to show you. There it is. 39. Big fat question. They even give you a whole separate file to look at. And that file included a blank settlement statement to work with. Here it was. There we go. In fact, let me do this. Make this a little easier to work with. There. So this is our monster question that we're going to need to Do lots of little baby calculations in order to end up with the big one. The overarching question was, what does the buyer need to bring? And let's take a look at this thing. Hopefully you have it. Maybe you have it nearby. So they just give us a whole laundry list of all of the fees associated. Obviously, you would probably do this last because you don't want to spend valuable time on other things at the expense of other things working on this, because they all count the same. This one question, which will take you, 5, 10, maybe even 15 minutes, going to count the same number of points as what's the definition of fee simple absolute. So they remind you of a 360-day year. How much cash does the buyer need to bring to settlement? Oops, sorry. There we go. And says charges and credits must be made according to the common practices of approved by the NC Realtors and NC Bar. That just means use your knowledge of who pays for what. You're going to need to know who typically, traditionally pays for each item. So a couple of ways you could do this thing. You could go down through it and just make notes and maybe calculate everything that's that you don't need to do a calculation for. You could write down everything you don't need to do a calculation for. That's a better way to say it. So let's start there. We're going to do credits. Credits and debits. We'll make a chart for both. And we'll just go down through the list. Okay. Fighting the technology today. Here we go. Credits and debits. For the buyer. Well, sales price is a big fat what? What's the sales price to the buyer? Credit or a debit? Oh, this is 39 from the state practice final. State portion, the state version of the practice final exam. What is the sales price to the buyer? A credit or a debit? Are they paying or are they receiving? They're paying. That's right. One big one. 124,900. Oh boy, here we go again. Sorry, guys. What's happening to my life? $124,900 is the debit, because that buyer needs to pay that. And then what's next? It just tells us the closing date is March 28th. Okay. In fact, you know what? I'm going to just make my notes and then I'll share this whole thing with you at the end. This dual thing is not behaving. Can you see that okay? Okay. Closing date is March 28th. I'm just going to make a little note of that. March 28th over here. Real property taxes for the current year, 1,014. They talk about the taxes have not yet been paid by seller. Well, really impressive, because it's March, so we're not really expecting them to have been paid. But it's good to know. Not yet been paid. Unpaid HOA annual dues are $250. Prorate at closing. Annual dues, $250. Earnest money deposit of 2,000. Well, there's something we can put in a column without doing any calculation. What do we do with earnest money to the buyer? To the buyer, that earnest money at closing is what? A debit or a credit? Currently looking like this. So yeah, that earnest money is a credit. It was what, $2,000. So we're going to put that here in the 2,000 in the credit column. That's earnest money. And then what's next? It talks about seller's loan payoff, 98,727. Seller's loan payoff doesn't matter to us. We don't need to do that. We don't need to do anything with it because all we're trying to concentrate on is what the buyer needs to bring. So seller's loan is irrelevant to calculate this one. Brokerage commission, 6% of sale price, split 50-50 between firms. All of that's nice information, but irrelevant. Because again, buyer's not paying it, seller's going to pay it. And we're not calculating what the seller needs to bring. We're calculating what the buyer is going to get. So we can ignore brokerage commission. Financing, well, that's going to be important. 90% loan, LTV, 30-year loan, fixed rate 6.5, 1% loan origination fee. All right, that's good to know. 1% origination fee and 0.5 discount points. That's 0.5. That's a half of a discount point to be paid by the borrower. That's important. So it's going to be a debit to the borrower, and one origination fee, 1% for origination fee plus 5% for a discount point added together is 1.5% of the loan amount. And we can calculate that loan amount because we know the price. Price is $124,900. And it's a 90% LTV. That means our loan amount is $112,410. And that means we need to calculate 1.5% of $112,410. That will tell us the total of both origination fee and discount point. And that's enough. That's all you need to worry about. In this case, it is another debit for both origination fee and discount points because all we're looking for is the final total. We don't need to spell these out separately all the way down the line. We can just calculate this one and put it on one line. 1,124.10. So there's that one. Both of those paid before closing. Borrower paid for an appraisal report and a credit report. Neither of these things are going to need to be collected from the borrower because they already paid them. They paid them back when they applied for the loan. They sat down with that loan officer, and that loan officer said, okay, you need to go ahead and write a check for the appraisal so you can pay for that so that it can be done and I can order it. And then also I need to run your credit report, so I need a check for $70 for that. And they collected it then. This was weeks ago. Now we're talking about the closing day. And so we don't need to even calculate these. These will show up on the report, though, because what they're going to see on that closing day is this. It looks exactly like this. This is the big closing disclosure. So somewhere on one of these two pages, or maybe on both pages, depends on the item, those fees are going to show up. You don't need to use this really. You could use this to do your calculations, but you're definitely going to have to use it in post licensing 302. But all you need to do is just use your scratch paper and calculate these numbers and just keep track of it. Are they debits? Are they credits? So paid before closing, another term for that is there. There's where it shows up on the column, paid before closing. Another term for that is paid outside of closing. You can just strike through them because all we're trying to calculate is what we need to collect from the borrower, from the buyer. Interim interest. Oh boy, here we go. Interim interest through March 30th for the borrower's new mortgage loan. All right. Well, oops. Let me write that back in there. That was 11.24 and 10 cents. All right. So, how many days is that? Interim interest. With interim interest, it's all about the buyer, the borrower. So if the closing is on March 28th, how many days worth of daily interest do we need to collect? This one's easy to calculate because it's just for the month. We don't have to calculate a whole year's worth or the rest of the year or anything. It's just for the month of closing, the month of March. So how many days worth? Once we calculate how many dollars the daily interest is, we'll do that next. But let's calculate how many days we need to multiply that by. You tell me. You can use your fingers. You can use your hands. 28, 29, 30. If you're looking over here on my little scratch pad, 1, 2, 3 days. Right? 3 days of interim interest, including the day of closing, because with interim interest, you have to also calculate and include the day of closing to the buyer. This is the one case where the buyer has to pay for day of closing. The way we remember why that is the case, instead of it being the seller like normal, is because there is no seller in this calculation. It has nothing to do with the seller. So $3 days. And now we need to calculate how many dollars per day. So what do we do to calculate annual interest in dollars? What's that? What's that look like? Tell me this way. What goes up here? That's the dollars of interest. That's what we need to know. Dollars of interest. But what goes down here? What are the two things on the bottom to calculate annual interest in dollars? The two things on the bottom are, there's going to be a rate. Which rate? Tell me in the chat. If we look back at our problem here, what do we know about the mortgage? It's a 30-year loan with a 6.5% rate. So we need the interest rate. And we need what? What do we multiply the interest rate by to determine annual interest? Tell me in the chat. Talking about the loan this time, right? If we're calculating something related to the loan, we need to talk about the loan amount. So it's going to be the interest rate and the loan amount itself. So what is that loan amount? We calculated it earlier. It's 90% of the sale price. So 90% of 124.9, I lost it. Let's see. 124,900 times 90%. is 112,410. Those are the two numbers we need. And if we do that, 112,410, the loan amount, times the 6.5% interest rate, that gives us an annual amount of interest of 7306. I don't know if you can see that. 7306 is annual. Now we need to turn that into daily. How do we turn that into daily? Anybody? Bueller? Anyone? There we go. Thank you. Divide by 360. So 7306 divided by 360 gives us $20.29. Call it $20.30 per day times 3 days. So the interim interest is going to be $60.89. 3 days worth of interest. That's what the buyer needs to pay for interim interest, because $60.89. Make some room here. Because the way this works is the month of closing is here in March. Then there's April, and then there's May. When you close here on March 28th, we just need to cover these 3 days of interest right here, because this whole month of April is going to be paid for on May 1st because of mortgage payments being in arrears, right? So the first full principal and interest payment is not coming due until May 1st. But you got to cover this gap of the remainder of the month of closing to satisfy that lender. And so the interim interest is going to be a debit of $60.89 total. Interim interest. Okay, what's next? Interim interest, private mortgage insurance premium. And we're going to come back up and do the property tax in a little bit. But we're just doing as we get to them here, 0.5% of the original loan amount. That's a premium. A premium is something you pay for a whole year. So the original loan amount was $112,410. So the premium is $562.05. What's happening here is the lender is telling the attorney with this information what they want the attorney to collect from the buyer at closing. And so if that lender's saying they want to collect the mortgage insurance premium of 0.5% of the original loan amount, the premium is the first year's worth. So we're just going to collect it. We're going to put that in the debit column, $562.05. Next thing on the list is homeowners insurance annual premium. They don't even make us calculate that. They tell us that premium is going to be $575. Again, the word premium, that just means you got to pay them the whole first year up front. And so here we go. Put it on the debit side. Hazard insurance, $575. Next, due diligence fee, $50. Oh, wow. Those were the days. Due diligence fee of $50, just like earnest money to the buyer, counts as a credit. Big, fat $50 credit. Loan escrow account deposit requirements. Okay, escrow account. You're thinking that's going to be a monthly thing. They're going to want to know how many months worth. They're going to want to collect a certain number of months worth of taxes and insurance. In this case, they want to collect for taxes, 8 months of taxes. They want to collect 2 months of homeowners insurance. They want to collect 2 months of PMI. And now they're talking some foreign language here. At the renewal rate of 0.35% of loan amount. What the heck? We haven't seen that before. They could ask you this in a couple of different ways. They're just, in this case, they're saying calculate what the renewal rate is and take 2 months of that, renewing it every month. So to renew it for 1 month is going to be, on my little scratch pad, if you can see that, 0.35% of the loan amount. And again, our loan amount is $112,410, so $112,410 times 0.35% sign, $393.44. And that covers the PMI. 2 months of PMI at the renewal rate of 0.35% of the loan amount. Then we need to calculate 2 months of homeowners insurance premiums. What was that homeowners insurance for the year? They just gave it to us. We didn't have to calculate it. It was $575. So $575 divided by 12, because it's number of months we're worried about here. 575 divided by 12 is $47.92 total to collect 2 months worth of homeowners insurance. Cost $47.92. The attorney needs to collect $47.92 from the borrower. That's for escrow. Escrow of the insurance. Now let's escrow for the 8 months of real property taxes. Taxes, oh boy, let's see. 8 months of taxes are how much? We don't need to worry about the proration here. This isn't the proration. This is how much are the taxes for the year. Now calculate 8 months worth of them. So what are the taxes for the whole year? Up here, third bullet point, $1,014 is how much they cost for the year. If they cost $1,014 for the whole year, we're going to divide that by 12 to get how much it costs per month. So it's $84.50 per month. And then how many months did they want us to collect for taxes? I believe it was 8. So $84.50 times 8 months worth. So that's another $676 for the tax escrow. Let's go ahead and take our break. When we come back, we'll keep on going through the rest of this. Keep working on it if you want to, but I'll see you in 10. As I find my place, let me find where I left off here. Oh, that's right. Wasn't it? Oh, that's right. I think I know. Sorry, guys. I lost my Oh, that's right. I think okay. Bear with me. Keep calculating. Keep going down through that list that I can't seem to find at the moment. There we go. There we are. Found it. It disappeared amongst all the windows. Okay, we left off after the escrow. Then it's just a list of things that the buyer needs to pay, frankly. Most of them. So after the escrows, oh, you know what? 1 second. After the escrows, the attorney fee came next. The attorney fee for settlement, that's a buyer expense. They would tell you if the attorney fee is for the seller to pay. They probably won't. There probably won't be one. Probably pretty much the only attorney fee that you might see that the seller's responsible for is preparing the deed preparation. So let's see. Let's see if I wrote these down right. Attorney fee is $375. That's going to be added to the debit column. Yep, we got that. The title insurance premium, lender's policy. Who pays that? Who pays the lender's policy for title insurance premium? Yeah, the buyer. Buyer's paying for whatever the lender requires of them. Even though it's a policy that covers the lender, the buyer still has to pay for it. They didn't put an owner's policy in here. If they did, we would include that too, but you work with what they give you. So title insurance premium $250. Just putting that on the debit column as well. Deed preparation fee is not a buyer expense, so we ignore that one. But deed recording fee is an important expense, so we need to record the deed to make sure that gets on the record. So $15 is going to go in the column only for recording, not for preparation. The mortgage recording fee. What do they mean by that? we're putting the mortgage, or in North Carolina, the deed of trust, the deed of trust mortgage document, it needs to be put on the public record, and it costs $28 at the Register of Deeds in this case to record it. So $28 is another line item just to write down in the debit column. Excise tax, we know how to calculate excise tax. It's based on price, and the price is $124,900. So $124,900 divided by 500 gives us $249.80, and we need to round that up to $250, right? Double check that. 124.9 divided by 500. Oh, sorry. What am I doing? Did you catch it? I'm calculating something the seller has to pay. Don't even need to be doing that. So, you know what? Happens to the worst of us. We can ignore this one because what we need to calculate is the total the buyer is bringing. Excise tax is not important for this question. Ignore it. Survey, $350. That's paid by the buyer. So we're going to put that $350 in the buyer debit column. Pest report, pest inspection report, $80. Another buyer one is one of the many inspections they probably had done, as well as the one next to it, the home inspection for $400. I wrote that down too. And then those last two items, a courier fee for sending, overnighting, mailing the loan documents to the buyer's lender for their new loan. $25 for the courier fee. And then they also talk about a courier fee mailing the final loan payoff amount to the seller's lender, but we don't care about that. Again, buyer's not paying for that one. So we just need to put the single $25 fee for sending the buyer's lender documents back, and I have that in the column as well. So what does that leave us with? We need to calculate the HOA and the property taxes. So what do we know about HOA? That was like the first or second item here. Unpaid homeowners association annual dues. They're not paid. And what happened when the taxes weren't paid for the whole year? How did we handle that when you needed to collect for them, right? We're closing September 1st or after, and taxes not yet paid. We calculate the seller's portion, and the buyer's portion, and we debit them each their respective portions. Same for HOA. Unpaid HOA annual dues prorate at closing. That just means how much is the seller responsible for and how much is the buyer responsible for through the end of the year, and debit the buyer's portion from them. So how many days is the buyer responsible for? If we close on March 28th, how many days for the buyer through the end of the year? Remember, the day of closing will mess you up. For HOA dues, for taxes, for everything except interim interest, who pays that day of closing? Seller always. So the safest way to calculate the days to the buyer is to calculate the days to the seller and subtract them from 360. So what are the seller's days? For closing on March 28th, that's the third month. March is the third month. That means there are 2 complete full months of 30 days each, right? January and February times 30 days is 60 days, plus just put in the closing date for March, the 28th. That gives us 88 days responsible to the seller. Now we subtract those 88 days from how many days there are in a year, and it's 272 days that the buyer is responsible for. That's a foolproof way to not lose track of the day of closing, right? Calculate seller days and subtract them from total days. So the buyer's number of days is 272. That's what I wrote up here, 272, upper right. And then now we need to figure out the daily HOA dues. If they are $250 for the year, how much are they for the day? $250 divided by number of days is 69 cents a day. Times 272 days. $187.68. You might have gotten 188 something like I did the first time because I didn't clear out of the calculator. Doesn't matter. It'll be close enough. Let's just call it 188 just to ballpark it. They won't give you an answer choice that is any more accurate than that. They won't give you like an answer choice that's 3 cents apart, for instance. So I got 188.89 when I did it the first time because I didn't clear the calculator. I left the entire number in it. So now let's calculate the property taxes. For the current year, let's see. It says they have not yet been paid by the seller. The year's worth of taxes are $1,014. So when they're not paid yet by the seller, it's also closing on March 28th. And it's also, that means before September 1st. So let's see here. How many days do we need to collect for? We need to calculate the seller's responsibility and then credit that to the buyer, don't we? Because they can't pay the bill yet. So we know the seller's days. We calculated them a minute ago. It was January and February are 60 plus 28 in March, so 88 days to the seller. And then we need to know dollars per day. If the whole year is $1,014, then dollars per day is 1,014 divided by 360. So that's $2.82 per day for 88 days. Let me clear it out. 2.82 times 88 days. That's 248.16. That's going to be a debit to the seller, but a credit to the buyer. We don't care about the seller's part. We just need to add it into the credit column for the buyer. I don't have room to label it, but I'm just going to write it in as a credit over here. 248.16. The HOA of 188 needs to be added to the debit column. Again, I don't have room for it. And that's it. Now we just need to calculate or add up all the debits and subtract the credits from them. And let's see where we stand. I make no promises. I have no answer sheet in front of me here. 124. That's my debits that I come up with almost. And then I need to subtract. Got pretty close. I forgot to add in that PMI at the first. So my debits needed to be another. I need to add in that PMI. But I still got 15,343.13. And the answer choices included the answer choice was 15,375. If I was in a hurry, I think I would have just probably picked the one that was the closest, and there it is. But how far apart are we? $31.87 apart. I'm not going to spend time figuring that out right now. I'll work on it later. We'll talk about it next week, or I could also put it in the Notion. We got pretty close. I guess a couple points here. How long did it take us to do that? Like 15, 20 minutes. You see my point? Save this one. Skip it. All you do is click the little thing at the top or whatever it gives you to skip. Come back to it. Do it last so that you don't just blow. Some people have this I've got to do it mindset, and they will spend too much time on such a thing. I'd say give it your best shot. Go back through if you do have extra time. Go back through and just kind of look at what they give you. Make sure you didn't make any of the common mistakes, and then pick the closest thing. Let me take a look here. Looking to see if I had the actual. I'll come up with the answer key by next time, but I thought I might have it close by. Okay, so yeah, look for the common mistakes. Make sure you didn't count things twice. Make sure that you calculated the typical problem ones properly, like property tax. HOA gets kind of weird. They could have also given that to us in months. They could have said, need to collect the current months, just settle up for the month of closing of HOA. And in that case, we're dealing with 30 days, not 360, because they're paid up to the month of closing, but not including it. That might be how they ask that. Or it might be an investment property, which involves rent, and you need to collect for rent. In that case, let's do that. If the problem includes, or there might be a standalone problem about it, but the rent's going to look like this. It could say that the seller is selling an investment property to a buyer. The closing is on the, let's just say 28th again. The rent is $2,100 per month. How will the rent be included or represented on the closing statement? If they're asking a standalone question, they could say it like that. Or they could just throw it into that big laundry list of a bunch of calculations, right? You're just going to need to know how much to calculate and how to count it, right? With rent, it's not for the year. It's just all about that month of closing. So we've got the 28th right here is the closing day. What do we know about the first of the month when it comes to rent? What happened on the first? Seller put $2,100 in their bank account. They collected it. They collected on the first for the month to come. So that seller has $2,100 that they don't get to keep all of. We need to calculate how much of this they don't get to keep. They have the whole month's worth in their possession. We need to remove the buyer's portion from them as a seller debit and a buyer credit. So the day of closing belongs to the seller. That means they get to keep the rent for the day of closing. So how many days are owed to the buyer? That's the word I want. If we're closing on the 28th, we don't include day of closing. Seller keeps that one. So that means 29th and 30th. Could have done it on our fingers. 2 days. So 2 days to the buyer at how many dollars per day? $2,100 for the month. Divide that by days in a month. $70 a day. $140 is what we need to give the buyer. You with me? As a credit. That's how the rent would be handled. Seller owns day of closing, whether they need to pay for it or whether they're getting money for it. This is the only case where they're getting money for it, in the case of an investment property rent. And similarly, it's an expense, but HOA could be handled per month. HOA is collected monthly, they could say. Or they could say quarterly, but let's say monthly. And it's $130 a month. And again, we're closing on the 28th. And the seller has not paid it yet. Seller has not paid the homeowners association dues for the month of closing yet. How do we need to handle this? If they've not paid it, then the seller's going to need to collect the amount the seller's obligated to pay. And we're going to need to collect the amount the buyer is responsible for, which are 2 days times however many dollars per day. And if it's $130 per month, that's 130 divided by 30, $4.33 times 2. So somewhere about $8.67 is what the buyer's debit column is going to have in it. The seller's column is going to be 30 days in the month minus 28 leaves 2. But don't forget to add in the day of closing. Wait, let me think. Does that make sense? Nope. Sorry. Getting too complicated. It's just that. Seller's days are 28 days times $4.33. Seller's responsibility for HOA on a monthly basis to settle up at closing would be 28 days worth of $121.24. Debit the seller that and debit the buyer this. Right? I might have gone fast. Might have gone too fast. Please tell me. Privately is fine. Tell me if you need more help. I don't mind. We could do a math session extra. Like, I don't know, maybe, let me think. It could be an evening. No, it can't be an evening. It could be a Saturday, during the Saturday. Tell me in the chat privately if you would benefit from just a math-only review session. I'm happy to do it. Let's keep going. Let's talk about tax. The big tax proration, the 3 possible ways. The big problem we just did had taxes before September 1st. So let's just do them all. Okay. Let's say that, let's be a little mean just to prepare you. So the purchase price is $213. The tax assessment is 70% of the purchase price. The tax rate is $1.21 per $100. And we're closing on August 3rd. How will taxes show up on the closing statement for both the seller and the buyer? How will they show up, need to be reflected on the closing statement? Yeah, good. I see that one. Reply. Keep replying direct private to me, guys, if you want a math session. Just curious. I mean, I'll do it for one person, but we have one person, so it's on. We just need to figure out a time. Let me think. We check with my schedule coordinator, aka wife, see what we got going on Saturday. We'll figure out a time. So what I'll do for that is I'll just come up with like maybe a couple hour time block, and I'll just open up the Zoom room just like this, and we'll just do math. And we'll do whatever else, but we'll do the math first. So I'll know shortly what our day looks like on Saturday in case I'm forgetting something. But there's somewhere in there that'll fit. Cool. And I'll record it too. Okay, so since I was a big jerk, I didn't just give you the taxes for the year. Got to calculate those taxes. So we have a sales price, we have a tax assessed value. So using that, we can get an actual tax value in dollars. 70% of the sale price. Tax value is $149,100. And so we know with our little T formula that always has a rate on the bottom, by the way. In this case, 1.21 divided by 100 is the rate. I didn't go into, is it in the city limits? Is it outside the city limits? I'd left you alone on that. We'll talk about it real quick in a minute. And then the tax value times that. I could have left that in there. 149,100. Since all of this is on the bottom together, it really doesn't matter when you divide by 100. But to properly do it, you should just divide the 1.21 divided by 100 so that the decimal ends up in the right place. But it works either way. You could do all of this and then divide that by 100. It's just going to look like a huge number for a minute. But let's do it right. 0.0121 times 149,100 is 1804.11 for annual tax bill. Now that we know what the annual taxes are, we need to figure out the daily taxes. 1804.11 turns into daily taxes by dividing it by what? I'll know tonight about that math session. Somebody asked. And I'll send you a reminder too. You're welcome. Well, tell me what to do about, what do I do to turn $1,804.11 into daily? There we go. Thank you. Divide by 360. Oops. $5.01 per day. Let me double check. Is that right? Did I mess up the calculator? Oh my goodness. My phone calculator has a nice little backspace that my fat fingers like. I don't seem to have that on here. Okay, good. Same thing. So $5.01 per day. Oops. Oh my gosh. There we go. And then how many days? That's the daily rate. Now we need to figure out how many days to whom. Start with the seller's days. If we're closing August 3rd, that's 8/3. That means there are 7 total months of 30 days each. 7 times 30 is 210, right? I think 210 days plus the 3 days in August. So the seller's days are 213. Does it make sense how I calculate those days? Good. You could use your fingers and toes and hash marks on the paper for all I care. Whatever it takes to get the right number, do your thing. But I find that's the fastest way that you can also kind of do it safely. Whatever the month of closing is, in this case, 8, go back a number. So that means 7 full months of 30 days each. However many that is, plus literally the day of closing of the month of closing. You can't screw it up. Now we got 213 days to seller. Do we need that? When is the closing? Is it before September 1st? August, September? Yeah, August is before September 1st. So we do need the seller's days. So we'll calculate the $5.01 per day times the 213 days to give us the seller's responsibility of $1,067.13. And in this case, it's going to be debiting the seller that amount and crediting that amount to the buyer, right? Now, let's make some notes here. We'll keep the same number. $5.01. Hopefully I can remember that per day. Now let's figure what it would be if the closing happened after September 1st. Let's say we're going to close on, let's say, just September 21st. September 21st is our new closing day. Everything else is the same. I'm not going to make you recalculate taxes. Our daily tax amount is still $5.01. You're welcome. Time, This time our closing is September 21st. And I owe you another piece of information. I need to tell you whether the seller has paid them or not. And they have. That seller is really responsible. 9/21 is the closing day. Seller has paid the taxes for the whole year. Take a moment. Tell me how that's going to be reflected on the closing statement. First step, we know our dollars per day, $5.01. Now we need to count days. Well, first, what are we going to do? What do we need? They paid for the whole year. That's all year. Here's our closing date. We need to give them back this much, whatever that is. But to get that much, which is the buyer's days, got to be careful. Calculate the seller's days and subtract that from the total. Seller's days in this case, if the closing is 9/21, that means 8 total months of 30 days each. 240 days is what that should be, plus 21. 261 days is the seller's responsibility. We don't need that dollar amount. We need to know what the buyer's portion is so that we can give it back to the seller. And so 360 days minus the seller's number of days is 99, I think, right? 99 is the buyer's days. 99 days at $5.01 per day means we're going to have an item on the closing statement of $495.99. And it's going to be a credit to the seller and a debit to the buyer. Right? Because the seller is out of pocket for the whole year. They need to get the buyer's number of days worth of money of taxes back in their pocket. And that's $495, almost $96. And then the final version of the possible three ways this could go, we'll keep our closing date, 9/21, but this time seller has not paid for the year. And I just erased everything, so we're going to have to remember what we did. It was 8 months times 30 days each, which is 240 days plus 21, so 261 days to the seller. And you could take that and get the buyer's days and then multiply them both by the dollars, but that's like extra steps. Let's just calculate the money for the seller and then subtract that money from the total money, right? So it's 261 days to the seller times $5.01 per day. Means the seller's portion is $1307.61. Since we're closing after September 1st and the seller hasn't paid yet, then we're going to take two chunks of money. The closing attorney is going to collect two separate chunks of money. This is not an official proration. This is debiting each one their respective amounts. We're debiting the seller that $1307.61, and then we're going to subtract it from the total to come up with what the buyer's portion is. $496.50. And debit the buyer that bit of money. Cool? It is 7:15 at night. I get it. We'll deep dive more on Saturday with it. I don't want to spend too much of the whole time on it because we got a lot to do. But work on that yourself. Hopefully if you're not able to show up on Saturday, you'll at least watch the replay. So in anticipation and preparation of all that, you can make up your own problems. You just need to come up with a tax value and a tax rate to determine annual taxes, or just have the annual taxes. Say if the taxes are $3,000 a year and we're closing on April 3rd, how do we handle the money? If we're closing on November 3rd and the seller has paid, or November 13th, November 13th and the seller is not paid, just do those. There's no answer key, but go through the steps. What are the steps? Let's do that. Taxes, the steps. Step 1, calculate the annual taxes and convert it to daily. Whatever you got to do to make that happen. You might have to multiply the tax rate times the tax value. They might just give you the annual taxes like they did on the Big Monster problem. But somehow you're going to come up with an annual tax, and then you're going to turn that into a daily tax. That's going to require dividing by 360. Step 2, calculate seller's days. Don't even worry about what you actually need to do in the problem, like what's it going to be, a credit debit, because everything you do, no matter which of the three, you should calculate seller's days first. That way you that you're not going to lose track of that day of closing. Step 3 would be Figure out what you do with the money. Credits and debits. Crediting and debiting who? Or are you debiting them both? Step 4, multiply the dollars per day by the number of days as needed, depending on which of the days, what the closing date is, right? That help? Have steps? What about calculating the actual annual taxes themselves? Annual taxes, step 1 would be get the tax rate, because that's what you base the tax paid on. Get the tax rate. That might require using a sales price and what percent of sales price the tax rate is. Or they might just give you the tax rate. It could also be called assessed value. Step 2, get the, sorry. Well, I didn't mean to say tax rate. I meant to say tax value. Get the tax value. Step 2 is identify the tax rate. It could be mills, in which case we know that means we're going to divide those mills by 1,000, or it could be dollars per 100, which means we're going to divide that number by 100. And then also, caveat, is it in the city or not? And then step 3, multiply step 1 and 2. Tax value times tax rate. That'll give you your annual taxes. Excise tax. That one's easy. Get the sales price divided by 500. Round up to the next dollar. But you already knew that. What about loan stuff? What about annual interest? Problem might look like this. They might say, what's the daily interest? Because again, if they ask for daily, you got to get the annual to get the daily. So the daily interest on a situation like this, sales price was $513. Loan to value ratio is 85%. The interest rate is 7.5%. The tax value is $503,000. The tax rate is 13 mils. What would be the daily interest with all of this information? You may not need all of this information. What's daily interest? If we were to cross out everything we don't need out of this list, are we crossing anything out? I'm looking at faces here. We don't need anything about the taxes, do we? This is about interest. It's about the loan amount. We need the loan rate and the loan amount. We do need these two pieces of information to get the loan amount, because we need to know what 85% of 513 is. So the loan amount is $436.50. Now that we know the loan amount, here's our T formula. Our rate is on the bottom, 7.5. Our $436.50 is the other thing down there. Gives us an annual amount we're paying out in interest of $32,703.75. That's the annual interest paid on borrowing $436.50 at 7.5%. But that's annual, so we ask for daily. So divide that by 360. The daily interest, $90.84. Good. The T formula stuff, there's a rate on the bottom, I think almost every time. And the other number on the bottom is going to be bigger than the number on top. Just as sort of a little self-check, just to help you, might help you remember what those formulas are. Speaking of that, let's see if we can list out some T formulas. So this one is interest rate times loan amount, gives us annual interest in dollars. There's also the tax one. The tax is in dollars. I like to say Ann Tax, good old Ann Tax. She's a nice lady. Ann Tax, annual tax, is the tax rate times the tax value. Might be called an assessed value. And that tax rate could be mils or it could be dollars per hundred. So that's another one. Anything where you're multiplying, you just put the two things you're multiplying on the bottom. Excise tax can be turned into one of these things. You could say excise tax is, there's 500 there on the bottom, and then that's going to equal the, sorry. Let me write it correctly. For excise tax, the excise is going to be on the bottom. And then the sale price is on top, because sales price divided by 500 is excise tax. And then don't forget to round up. Oh, what about some of that original math, converting square feet to acres? How many square feet are in an acre? That's just a memorization thing. Acreage. Have any trouble remembering that number? Those little old ladies? For little old ladies going 35 in a 60-mile-an-hour zone is how many square feet are in an acre? So the problem could be like this. There's a lot that's 315 by 713 feet. Prices of land in that area go for $57,000 per acre. How much for this lot? Do we have enough information. We can get the acreage, and we know how much per acre. So find that acreage first. You can draw it out if you want to. The first number given is the street frontage. So that tells us that this thing is longer or deeper than it is wide across the street. So that 315 times 715 gets you your square footage. Oops, 315 times 713. Who came up with that weird number? 224, 595 is the square footage. You could plug that in to a T formula because we know that there are this many square feet in an acre. And that's going to give us the number of acres. So that big fat number divided by 43560 tells us that this lot is 5.16 acres. 5.16 acres. That's our acreage of the lot. And lots are selling for $57,000 per acre. So now we just multiply that 5.16 times 57,000. So this lot should sell for somewhere around $294,120. Pretty simple. What if they said instead of per square foot or per acre, how much is it per front foot? How much would this lot cost? Actually, yeah, let me give you that. Okay, so things sell for, I don't know, we're pulling randomly, $13,000 per front foot. How much would this lot cost if they were valued at $13,000 per front foot in this area? What do we need to do? Front foot is what? Which of those measurements is front feet? The first one, yeah, 315. So 315 is the front footage times the 13,000. This lot is worth $4,095,000 if it's worth 13,000 per front feet. I think I choose to sell it that way. If you know the T formula version, then it doesn't matter what they ask for, because you can just plug them in. That's the value of it, right? We used it. We knew our square feet. We always know what this is, square feet in an acre, to get the acre. What if they instead, and then we'll take our break, what if they didn't give us the square feet, but they gave us the acres? What if they said a lot has 3 acres? That won't be that nice. It has 3.5 acres. .5 acre lot. And then the question is, actually, let me have that for you when we come back from break. I just thought of something else. So I'll see you in 10.
Hey, look who it is. Good, bro. What, finally back in the cars? You know what it is? Come on, come get these ones. You're not safe. Finna wax you just like old times. I promise you it's different. Ain't nothing different. Oh. Whatever, bro. Come on. He ain't shooting that. You know he ain't shooting that. Come on now. Try to tell you, man. Try to tell you. Man, that D1 don't mean nothing, bro. I swear it don't.
I'll tell y'all follow me, boy.
Hey, look who it is.
Good, bro.
What, finally back in the cars? You know what it is? Come on, come get these ones. You're not safe. Finna wax you just like old times. I promise you it's different. Ain't nothing different. Oh. Whatever, bro. Come on. He ain't shooting that. You know he ain't shooting that. Come on now.
Try to tell you, man.
Try to tell you. Man, that D1 don't mean nothing, bro. I swear it don't.
I'll tell y'all follow me, boy.
Hey, look who it is.
Good, bro.
What, finally back in the cars? You know what it is? Come on, come get these ones. You're not safe. Finna wax you just like old times. I promise.
4, 3, 2, 1, challenge.
Have been following me.
Ma'am, I'm just trying to tell you.
Oh,
You
no,
got.
I have it all on tape.
I was just trying to tell you you left the nozzle in your car. You can't take the gas station with you, hon.
You have been following.
And who are you, sir? And what do you do here? What is that? What's the V? Oh, fuck, this guy does everything. Challenge accepted. I've never seen an audience member pipe up over another audience member's qualifications. This guy can do everything. Hey, he can't do water.
Welcome. Wait a minute. There we go. Welcome back. Come on back in together. As to Saturday, what about like 10 to noon, 10, 11, 10 to 12, that 2-hour time block, somewhere in there? How's that work for people? Tell me in the chat. Or would starting at 11 be better? Want to start at 10 or start at 11? Survey says. Should probably make a survey. Got an either? Let's give something from everybody. Tell me whoever's planning to go. If or just tell me if that doesn't work. We'll call it 10 to 12 unless somebody tells me otherwise, and then we'll figure it out. In the meantime, look on your screen. We've got more creative acreage question. I've seen these show up before. The lot is 3.5 acres. The front footage is 450 feet. How far back does the lot go with these numbers? Now you're going to have to manipulate that T formula a little bit. I like to draw diagrams. That can be useful. Front footage is 450. I'll just make a square since we don't know how far back it's going to go. I have a feeling it's going to go back further. But the acreage of it is 3.5 acres. So, for you T formula folks, what we don't know is the square footage. That's what we need in order to divide it by 450 to get this thing. But it all starts with the acres, 3.5. 3.5 acres times the square feet in an acre tells us that it's 152,460 square feet in the total lot. And since it's, we'll just say width times depth of lot equals total square feet, there's a little T formula we just made up. What we know is the width, 450, and the total square feet of 152,460. So divide 152,460 by 450. Tells us our depth is 338.8. So it's actually more of a flat rectangle, barely. It goes back 330, almost 339 feet. Good. That's why those T formulas can be useful, so you can just plug them in, plug and play. Let's look at our practice test again. We had 38 was another state one requested. All right. I didn't like how this was worded, because they said that she paid it on January 1st for the current year. It's like, that's not how we do it. We don't have to pay it. We can't pay it on January 1st. So I have a bit of an issue with this, but I just went back to how you do these problems in general. So let's see if that works. If we're closing on June 23rd, that's before September 1st. How do we handle this? How much, it's specifically asking how much would she be credited at closing? If she's paid the whole year, even though we know that taxes can't be paid until September 1st, they're asking the question a certain way. So work with what you have in the question. The closing is happening June 23rd. It's closer to the halfway point. They're telling us the taxes are paid for the whole year. So we need to figure out how much is credited back to the seller. It's going to be the buyer's portion. Ignore the part about how they're kind of breaking the standard procedure. They're telling us the taxes have been paid for the whole year. They're telling us that they want to know how much to credit back to the seller. So work with that information. Calculate the daily taxes. If they're $23.45 a year, we're going to divide them by 360 to get our daily taxes. $6.51 per day. Step 2, seller's days. So we don't lose track of that day of closing. Seller's days. If the closing is in June on the 6th month, that's 5 months at 30 days each. 150 days plus the 23 days in June. 173 days to the seller. But we need specifically the buyer's days because it's the buyer's portion that will be credited back to the seller. So we could do a couple things. We could either calculate the money and, well, yeah, we do know the total money, so let's just do that. $6.51 a day times 173 days means the seller's portion is $1126.23. But let's subtract that from the $23.45 to find out what the buyer is responsible for. And there it is, $12.18. See? Oh, sorry. There was my calculation there. Calculated the seller's portion, but what we needed was the buyer's portion because the whole year's worth has been paid. And we need to calculate what the seller's getting back because that's how they worded the question. In real life, there's no way the seller's paying on January 1st. It's not how it works. But just work within the confines of the question. There were a couple questions from the National. I had 42, 62, and 56. Let's take a look at those. 42. Keep bringing them, by the way. 42. When a personal judgment is properly recorded in the county in which the defendant resides and owns real property, the judgment becomes what? All right. Personal judgment. Personal judgment. What is that? That could happen if you go to court, you're sued, or somehow the judge levies a dollar amount on you because you owe something. It's been determined that you owe something. So, properly recorded, where they own real property, is that judgment called a voluntary lien? Remember, voluntary liens are things that you're happy about. Sort of, right? You're happy about putting the mortgage on the property. That's a voluntary lien. A mortgage is a voluntary lien because otherwise you couldn't have the house. So while nobody wants to have to pay a mortgage payment, the alternative is not owning the house. So yes, that's a voluntary, but a lien or personal judgment put against you is because of a negative thing. That's an involuntary lien. A special assessment is an involuntary lien. Any other kind of penalty kind of a thing as an involuntary lien. So that's where that comes from. Not voluntary. Is a personal judgment a specific lien? Remember, a judgment sticks to you, the person, even after that closing happens. It doesn't get cleared up at closing. It's riding your shoulders through life until you pay it off. So it's not a specific lien because it's not specific to the property. Even though they talk about properly recorded in the county where they reside and own real property, a personal judgment sticks to the person. It's against them. So therefore, a specific lien doesn't work. It's a general lien, but a general lien isn't one of the options. An equitable lien isn't a thing. We didn't talk about that. That's not a thing. So the best answer here is involuntary. See that logic? Is that okay? 52, I think, was the next one. Fannie Mae and Freddie Mac have a common purpose of what? Okay, that's a good segue into this topic. Fannie Mae and Freddie Mac represent the marketplaces in the secondary mortgage market. After loans are made individually to people, those loans are packaged up according to their levels of risk, according to the originating guidelines, and then they're put together in big chunks and then bought and sold. So what Fannie Mae and Freddie Mac do is purchase these loans in big chunks. Remember, they're not originated by Fannie Mae or Freddie Mac. The origination happens one-on-one with the mortgage company, the lender. The lender that you sit down with and apply for the loan from, they're originating the loan. Originating means creating it. The Fannie Mae and Freddie Mac do not insure the loans, nor do they guarantee the loans. Who insures residential mortgage loans? Well, the word insure is a very important word to think about. And so is the word guarantee. if we're talking about the loan being insured, then tell me which type of loan is it? I'll give you choices: conventional, FHA, or VA. Which of those three types of loans are insured by the government? Which one is insured by the government? FHA, VA, or conventional? No. Not VA. And it's not conventional. Conventional is not backed up by the government at all. It's not insured or guaranteed by the government. FHA, write this one down. FHA loans are insured by the Federal Housing Administration, which is FHA. FHA insures loans. VA loans are guaranteed by the government. FHA loans are insured by the government. VA loans are guaranteed. What does that mean? The government steps in and says, hey, we're requiring this private mortgage insurance, and then if the borrower defaults, we will back this loan so that it can be bought and sold in the Fannie Mae mortgage market. Remember, Fannie Mae prefers private loans. They prefer conventional loans. Fannie Mae, that marketplace, they like the best loans. The best loans mean the lowest risk ones, the ones that are most likely to get paid back. So Fannie Mae is the biggest, oldest, most common marketplace for loans being bought and sold. Fannie Mae would rather only work with conventional, but they will work with and buy and sell FHA and VA loans, but only because the government backs them. Fannie Mae says, well, okay, we'll mess with those other kinds of loans, but only because the government will help make us whole if those loans get defaulted. So, what kind of loans are insured? The word insure, you think FHA loans. What kind of loans are guaranteed by the government? You think VA loans. VA loans are guaranteed. Very important words here. FHA loans are insured. Who can get a VA loan? What people can get a VA loan? How do you qualify to get a VA loan in terms of what you are, who you are, or who you're related to? Yeah, that's military. But be careful about that. Military, meaning veterans and active military, can get VA loans, but so can their spouses. And also, don't forget, VA loans can be assumed. And they can be assumed by anybody, military or not. So it could be that a VA loan gets assumed by a regular civilian. The thing is, when a civilian assumes the loan of a veteran or a VA loan from a veteran, military person, then that veteran no longer has the ability, that amount of money that they can borrow in another VA loan later. They better not need their VA eligibility for a while, because the entire time that civilian that they let assume their loan has it, they have that much less eligibility to borrow if for another VA loan. They better be able to get a conventional or an FHA loan, but they probably have used up all of their VA eligibility. If that civilian who assumed their VA loan refinances into a different kind of loan, then that veteran gets their eligibility back, and now they can go get another VA loan for the full amount they qualify for. You with me? So a VA loan could be held by a non-military person, but it's only in the event of an assumption that would have had to have happened. A VA loan is going to be originated only to veterans, military, and their spouses, and/or their spouses. So let's see. VA loans are guaranteed. The government bridges that gap where MIP and PMI would normally be handled, right? Because on an FHA loan, if you're putting less than 20% down, the requirement is that you, the borrower, also pay for mortgage insurance. So 20% is that magic down payment that the lender would really rather you put down. But the whole point of an FHA loan is that you can't afford that much money for down payment. So you're probably paying the minimum down for FHA. By the way, the minimum down payment for FHA currently is 3.5%. So that means that instead of having the amount of skin in the game, so to speak, or your own risk of loss, because you don't want to walk away from 20% of your own money, you don't have 20% of your own money, you couldn't afford that much down, you only put the bare minimum 3.5. So the entire difference between the 3.5 you put down and the 20% they would rather you had put down needs to be protected in the form of mortgage insurance. And when it's a FHA loan, it's called an MIP, a mortgage insurance premium. That mortgage insurance policy is covering this amount, the difference between your actual down payment and the amount they wish you would have put down, the 20%. So that's an FHA. If it's an FHA loan, the mortgage insurance is called MIP, mortgage insurance premium. If it's a conventional loan, it works in a similar way. It's just that instead of 3.5 minimum, it's probably going to be more like 5% minimum down for conventional. But the mortgage insurance for conventional is called PMI, not MIP, but it's the same type of deal. It's still mortgage insurance. It covers that gap, in this case between 5% and 20%. Or what if they put 10% down? Then the PMI only needs to cover that 10% difference between 10 and 20. You see what I'm saying? Or if they put 15% down, it's only going to be PMI based enough to cover that 5% difference between the 20% that the lender wishes and the actual amount that was put down. So it's still mortgage insurance, whether it's called MIP or PMI. The other big difference is on a conventional loan, this PMI is no longer necessary once the borrower over time has worked their way up because of various ways to attain this level of 20% equity. How can they attain this level of 20% equity? A couple of ways. It could be due to appreciation of the property. Property became worth more over the last 5 or 10 years. So the more the property is worth, the greater equity the owner is going to have in it. A percentage of what it's worth, right? Equity is a percentage of what it's worth. It could also be because you paid extra on your payment. So you're beating the curve, right? You were on schedule to pay this off in 30 years, but you've been paying extra every month for 10 years. Therefore, you probably knocked about a third of your time off your total. You could probably pay that 30-year loan in 27 years if you pay just one extra payment a year. So paying extra, it could also be that you do an improvement, capital improvement that makes the property worth more. Any of these three things increases or speeds up how quickly you attain 20% equity. And when you hit that 20% mark, you can tell your conventional lender, look, I don't want you to charge me PMI anymore. You don't need to, because the whole point of it was because I had less than 20% equity and now I don't. Now I have at least 20% equity. Stop charging me this. They actually have to stop charging you once it hits 22, but you could petition them to stop charging you at 20. You just have to prove it. And you'd probably have to pay for an appraisal to verify it. Now, while PMI with a conventional loan is removable, it's temporary whenever you hit that 20%, the MIP for an FHA loan never goes away. That's the big difference. The reason you did the FHA loan instead of the conventional loan in the beginning, when you first bought it, was because the FHA loan allowed for a lower down payment. It allowed for a lower credit score. And that's pretty much it. So it might be that was the only way you could get a house because that's what you had to work with. Oh, it also allows for a higher debt to income ratio, meaning more of your monthly payment plus recurring expenses can be toward the house, more compared to your gross monthly income. The debt to income ratio on a conventional loan for your purposes in this class, 2436. Is that right? Or was it? I just totally blanked on the 21. What's the front end ratio? Is that right? Why did it fall out of my head? It just fell out of my face. Now I've got to check it. Of course, they're showing me real life stuff, not the one you need to know for this class. Sorry, guys. Tell me in the chat if you know it, find it quicker than I do, because I just totally flaked out on you. It's chapter 14. No one? No one can show me up right now? Come on, I dare you. Make it happen. Oh, it's 28. I just remembered. I haven't found it yet, but it's 2836. Yep, 28% is the front end ratio for a conventional loan, meaning no more than 28% of your gross monthly income can go toward your mortgage insurance, your mortgage payment, PITI and PMI. Anything just the house specific stuff is 28% maximum for a conventional loan. So, qualifying ratios for a conventional loan. 28% of gross income monthly for PITI plus PMI. And then it must be no more than 36% of PITI PMI plus recurring debt like credit cards, car payment, anything recurring. Not utilities, but recurring things of the gross income. You need to know those for conventional, but not for FHA. But just for your information, the way conventional and FHA compare with these ratios is FHA is probably going to be more like 43. They allow for a higher percentage of your all of this stuff to be spent from your gross monthly income, which would be another reason somebody would pick an FHA loan. But they need to understand, look, okay, this gets you into the house, but just so you know, don't even bother trying to hurry up and get to 20% equity, because you won't get out of that MIP. You got to pay it the whole time. But here's another way you could word the question. How can an FHA loan borrower stop paying MIP? How can someone with an FHA loan stop being required to pay MIP? It's almost like a trick question. Stop having an FHA loan, refinance into a conventional loan. So they might start with an FHA loan because that's the only way they can get a house. But then they work and they save and they bust their tail and they get their credit score up and they save extra money so that they can refinance that house into a conventional loan. And now they can have maybe not even need PMI because they have enough for 20% equity. So they can refinance into a nice lower LTV, lower loan to value mortgage. So a refinance would do it. Selling the house would do it. And then they're paying off their FHA loan, and maybe then the next one they buy doesn't need to be an FHA loan. Even a military person who qualifies for a VA loan should still shop. You as a broker should advise them, look, you should still see what the lender tells you about your chances of getting a conventional loan because it's cheaper. There's fewer expenses along the way. There's good reason to be a conventional loan haver instead of an FHA or VA. If you don't have challenges with down payment or credit or qualifying ratios, then go conventional every time. They cater to you more also because higher credit score is what they would prefer to have, better likelihood of you paying it back. Okay, we really went around our elbows to get to other places with that one, but I think it's useful. 56, 42, and 62. Let's see, 56. Federal agency that is tasked with the oversight of the public welfare in connection with lending practices is who? All right, a recap. 2008. Anybody watch The Big Short? Do it. Watch it, read it. If you're a reader, that's probably even better. But at least watch the movie. It'll give you some insight as to what happened. It was actually not a bad recollection of kind of what happened. It's dramatization, but it's close. That same guy in the movie. Oh, thank you. Oh, that same guy in the movie of The Big Short, main guy that I think lost his name. I can't think of his name. The main character, Patrick Bury, I think is his name. He's voicing his opinion about our current situation, our current economics too. So look out for that. But 2008 came around because the lenders got too free and loose with their qualifying. They approved everybody. People literally could get the keys to the house and 25% over the loan amount at closing. And you know they didn't use that money wisely. Some of them probably bought cars or vacations or whatever. But they started giving loans to people that didn't have good qualifying, didn't have good credit. Subprime mortgages mean mortgages that are not good credit scores, but they still thought, the lenders thought, well, it's real estate. Why would anybody stop paying their house payment? They would let their car go into collection before they let their house. Wrong. You ever driven through lower income properties or neighborhoods? You see pretty nice cars out in front of those lower price range houses. People like their cars and they keep paying that car payment because it's lower. What about that logic? It's kind of funny in retrospect. We're all geniuses though, aren't we? But yeah, I would keep paying my $300 or $400 car and then maybe let the house go because that's like $1,000 or $1,500, and I can just go rent something maybe, hopefully, if my credit doesn't get too trashed. And that's what they did. People did that. So part of that 2008 stuff that came about was the government stepped in and said, hey, you lenders really screwed this up. We need to oversee stuff. So now what loans are overseen by the government? What loans are government related or federally related? All of them, even conventional ones, because of the government oversight. Look out for that as a test question. The following types of loans are federally related: conventional, FHA, VA, ABCD. Well, all of them. Well, ABCD is not a real loan, but even conventional ones, because they all have this government oversight thing. The Consumer Financial Protection Bureau, CFPB, was created as a result of all that stuff to fix the problem that had emerged. Another thing that you'll see when we're talking about this topic in your book is the Dodd-Frank Act, the legislation called the Dodd-Frank Act, which again is to fix it, keep it so that lenders can't do that anymore. They actually are doing it again. They've come back around, they've renamed it, but now they're making loans to people that are really basically subprime loans. So it's just a matter of time. We'll see if they get too free and loose with loaning money to people that maybe aren't as good of a risk. And we'll just see. I don't think it's ever going to happen like it happened, but lenders make money. They can charge a lot of extra money on interest of these subprime loans. They got addicted to it. They basically printed money because they can charge whatever. because the people with challenged credit were so thankful to get a house. They were willing to pay ridiculous extra money to get this thing. So it's not the Federal Reserve. The Federal Reserve is the overarching entity that helps regulate the economy. There's 12 branches of the Federal Reserve across the country, 12 Federal Reserve branches. And so the Federal Reserve is the thing that loans the money to your bank so that your bank can loan that money to you. And so the rate that the Federal Reserve loans the money to your bank at is a lower rate than what your bank upcharges it and then loans to you at, right? So that's kind of just how it works. So that's the Federal Reserve. They are not overseeing the public welfare in connection with lending practices. That's not the Federal Reserve's role. Their role is to loan money to your bank and to oversee. And they also help with Fannie Mae to come up with guidelines for qualifying and for making loans. The guidelines part. Housing and Urban Development is the Department of HUD, the government department. That's not overseeing lending practices. HUD does several things. One thing HUD does is we saw HUD when it came to fair housing enforcement. Federal fair housing laws, you report violations to HUD. The state ones you report to the state department, but for federal ones you report it to HUD. So that's not this. Federal Trade Commission, that's the FTC. That's not this. We didn't talk about the FTC in this course. So Consumer Financial Protection Bureau was created along with the Dodd-Frank Act to help clean up the mess that came about from the 2008 catastrophe. So that's that one. 62. Charges levied on a property owner to pay for installation of sewer and water lines are special assessments. Anytime the government needs to do something in an area and it benefits the public, then those in the immediate vicinity get to pay for it in the form of a special assessment, right? Could be for sidewalks, could be for curb and gutter or street lights. And that brings up a math problem that you could run into also. Let me show you that one. The special assessment math problem you could find. It looks like this. It'll talk about streets being repaved. Here's our street. And this person over here owns this lot. And this lot is 300 feet across the front and 450 down deep, down the back. And it says that there is a government special assessment for repaving the road at $80 per foot. How much? Oh, they'll probably also throw this in. They'll say the government is going to cover 20% of that. How much will this person have to pay? This person who owns this lot. And so what you have to remember is that road serves more than that person. There's somebody over here that owns the property across the road. So they're going to get to share in that special assessment. So first of all, let's get rid of this 450 because it doesn't matter for this problem. How much is this person over here, we'll call them person A, gonna have to pay? Well, they're gonna have to pay $80 a foot times 300 feet because they have 300 feet of road frontage. So 24,000 But then the government's covering 20% of that. So they're only going to have to pay 80% of that. But then that's going to be one of the answer choices. But then you're going to have to remember, wait a minute, they own 300 feet along the road, but they share that section of road, so to speak, with the person who owns 300 feet of that same road frontage over here. Even if this person owns more than that or less than that, somebody over here is going to cover half of this. So this person, owner A, is not going to be charged $19,200. They're going to be charged $9,600 because the people or person who owns this stuff over here gets to split it with them. Does that make sense? When you're talking about repaving a road, just calculate the number and divide by 2 because the owners over here split it with them because they also benefit from this road being repaved. So you might see that as a special assessment problem. Be aware of the other person across the street. Oops. Okay. I don't see. Tell me if you still have other numbers. Otherwise, I'm just going to keep going and look for things that I think you might have questions about. On this, currently we're on the national section of the practice final exam. Just going to start at the end and work backward. But not math. We'll do that. Well, yeah, we'll do math too. Okay. Well, yeah, let's just start here. Assume that the listing and selling brokers split the commission evenly. What's the sales price of the house? So we're basically working backwards. We initially learned this thing by calculating the commission once we knew the price. But you need to be able to go the other direction too with your math. Let me see if I can get away with this time. Hopefully you can still read that and also see this. Oops. Okay, so selling brokers are splitting the commission evenly. What's the sales price of the house if the listing broker receives $25.93 and the total commission is $6.50? So we have a listing side and we have a selling side. And they're splitting it evenly. The listing broker has $25.93.50, and so does the selling broker. We're not talking about, don't worry about individual humans versus firms. Let's just deal with it as if they're talking about firms. So both of these are happening. So $25.93.50 times 2 is a total commission of $51.87. That's the total commission dollars. $51.87 is 6.5% of what? So another way to write that is $51.87 equals 6.5% times the sales price. And so we know two numbers. We could refashion this. Again, anytime you see the equation of multiplication, something times something, that's on the bottom. Put the other thing on top. So the 5187 can be up on top there. Oops, let me move that over. And so that means we just divide that 5187 by the 6.5%. And that tells us our sales price is $79,800. How did that feel? That hard? That okay? Tell me if it was not. If it didn't make sense. Again, working with what they give you. Don't start adding things in with your own mind, thinking, wait a minute, listing broker, what about the firm? What about the person? just work with what they give you. The one side versus the other, both together were 6.5%. So therefore, the 5187 is 6.5% of what price? Seller has collected rent. Oh, here's one of those where we got to write basically a grocery list and keep track of the different levels of rent. Sellers collected the September rent from all 5 tenants. 2 paying $345 per month. Okay, 2 at $345, and 3 paying $425. I can't write threes. I'm too impatient to write threes. $425. How much rent will be credited to the buyer at a September 19th settlement? 9/19 is our closing. What are we giving to the buyer? Okay, well, let me get that back out of my way. It's a 9/19 closing. How much is that total rent? We just need to figure that up. Is that $690? And then that's $850? Nope. It's 3. 425 times 3, 1275. And then the 345 times 2. Good. Gave us a total rent collected of $1965. That's what the seller collected on September 1st. But they don't get to keep all of that because they only get to keep the part that goes up to the 19th and including that. They've got to give back this part. How many days is that part? We're calculating seller days first. So 19 days. How much is the daily rent out of that total? $1965 divided by 30 is $65.50 per day. Times 19 days, that's what the seller gets to keep. Seller gets to keep $1244.50. But that's not the answer to the question, because the answer to the question is how much do they need to credit to the buyer? It's going to be the total minus what the seller gets to keep. There's our $720.50. You okay there? Looking at faces again. Okay, good. An owner wants to net $56,500 from the sale of the building. The seller must pay a 7% commission and a marketing allowance of $160. Round to the nearest dollar. What's the minimum selling price under these facts? Pretty small number of things to keep up with. Who cares what the marketing allowance is? It's just another item. They could have said repairs that are needed. They could have said closing costs, but just a $160 line item. So they need to pay $160 for the marketing allowance. They've decided to pay that to this agent. And they also need to have left over after everything $56,500. So they need to add those two things together. So they need to have $56,660. That's how much they need after they sell it and pay the agent. So the $56,660 is, what was the commission? 7. So is 93% of what? Sales price. That means you just stick a division sign in. Another way you could do it is the way we just did it. $56.50 equals 93% times sales price, which means you could just put that $56,660 on top and make yourself a nice little T formula real quick. So $56,660 divided by 93% gives us the sale price of $60,925. Right? They could have made it more complicated. They could have given you more dollars to add up here. But the main thing is this part. Remembering to divide the amount they need to end up with, not including commission. Divide that number by how much of a percentage the seller gets to keep from the full sale price. Seller gets to keep 93% in this case. The agent is going to get 7. When you do that division, it tells you what it needs to sell for. So that agent gets their 7. Because their 7% needs to be based on this sales price. It better not be based on that 56.6, because you would be cheating yourself out of probably thousands of dollars. And you're worth it. Let's have a break, and I'll see you in 10. came back. Welcome back. Hope you're coming back. Where did we go? There we go. Okay. Okay, next question. Small office building sold for $949,000. The broker got a commission of $54,990. Oh boy. What was the commission rate? They're doing some acrobatics. Again, if you know the T formula or if you can make one yourself, it's easy just to plug and play. So, what do we know? If it's normally we would take a sales price, we would multiply it by a commission percent to get the dollars of commission. So that's easy to turn into a T formula. Just put the thing on top of the stuff that's multiplied. What we have here is a, let me write that better. Sale price times commission split or commission percent equals dollars earned. Well, we know the dollars earned, it's $54,990. We know the price, $949. What we don't know is this, but we do know that all we have to do is divide to get it. It gives us a decimal of 0.0579. We just move that decimal over 2 places. The commission rate would be, in this case, we'd round up to the 5.8. Easy enough? Okay. They were very generous with the math on this one, weren't they? Let's do some stuff that's not math for a little bit. Here's one. Formula for net operating income. Net operating income goes back to that given acronym. So we know that's potential gross income. Subtract out vacancy / collection losses and subtract out operating expenses. And that's it. That's how you get to net operating income. When I first read that myself, I was thinking about the cap rate version. But in the answer choices, they don't give us anything to do with the cap rate. Work with what you get, right? So best choice out of this. D is, of course, not right because net operating income does not factor in debt service at all. That's not part of it. Fixed expenses that the property manager should consider when developing the operating budget include everything except what? Be careful. I've done this myself. I've missed some questions because my brain just doesn't register. Which is it? Are we looking for things that are true or are not true? In this case, we're looking for things that are not true. The expenses the manager should consider when developing the budget include everything except which one. It includes employees' salaries. Those are fixed. It includes real estate taxes. We know what those are going to be. Insurance premiums. Repairs are a question mark. Who knows what needs to be fixed? Probably not that hard of a question. What needs to be repaired, I should say. And then functions of the property manager include all of the following. And again, which one does it not include? It does include getting the best possible NOI. Right up their alley. It's exactly what they're there for. It also includes making sure the property is maintained and preserved, carrying out a fiduciary relationship to the owner. That's the whole point of having an agent, is to have a fiduciary. So let's talk about other property management things while we're at it. What kind of relationship does that property management manager have to that owner It's a fiduciary one, but which one is it? Is it special agency, general agency, or universal agency? Property manager to the owner's relationship. It's definitely fiduciary. They owe all that fiduciary stuff. But are they a general agent, a universal agent, or a special agent when it comes to property management? In the chat. Tell me in the chat. What would a special agent be? What's an example of a special agent relationship? Remember, we're not talking about buyer agent, listing agent stuff. We're talking about a broader category. Special, general, and universal are bigger categories. It's sort of like saying a fee simple absolute is a type of estate, or it's like saying subject to is a type of defeasible, and defeasible is a type of inheritable. So buyer agency, listing agency is a type of special agency, right? We do that on the sales side. An agent to a client's relationship is a special agent relationship, meaning we have the least amount of authority, ability to sign on their behalf. Special agency is the lowest of the three. General gives you even more ability to sign on behalf of your client. And so a property manager would sign leases on behalf of their client. They could execute the eviction process, go to court instead of the client. They can do more on behalf of their owner client, property owner client. Universal agency is the one that includes the most authority on behalf of someone else, and we don't really do much of that in real estate unless maybe our client gives us power of attorney, meaning we would be the attorney in fact on behalf of the client. Not a great idea. Who wants that kind of pressure? But you could. Your client could give anybody power of attorney to sign for them. But that's sort of a unique case, a special case. The normal chain of events, special agency is involving with purchases. That's what buyer agency is. That's what listing agency is. That's what helping a renter is. But property management, helping an owner, general agency. There's another place where general agency occurs, and it was actually one of the questions, I believe, on the state portion of this exam. What's the other kind of general agency relationship? Who is that between? The broker and who? The broker and their firm. You got it, Samuel. Because you can sign things on your firm's behalf. Remember, if you look in your Google Drive, you can see that listing agreement and the buyer agency agreement. They both have a place for a broker signature. It's not your BIC. It's yours. You sign on behalf of your firm as a general agent for your firm. So that's what all that's talking about. So functions of the property manager does not include applying a gross rent multiplier. Who does that? The purpose of a gross rent multiplier is what a potential investor, maybe it's what your property owner client, you're the property manager, might be what your property owner client did when they bought the property, just as a rough guideline to see if the property was priced right. But that's not something the property manager even needs to do. We're past that point. The use of a gross rent multiplier is to figure out what you should maybe pay for the property. Is it asking too much? Is it priced too high? And if you'll remember that gross rent multiplier, where does that fit on the T formula? It's right there. It's what we multiply by the rent to get how much the sale price should probably be. So if we know that things are rented, I think this is straight out of the book, for $650 a month, and the gross rent multiplier that we've calculated, that we've educated ourselves to know applies to property like this here in this location. Gross rent multiplier for properties like these is 126.2. We multiply those together, that should tell us what our maximum we wouldn't want to spend more than to obtain the property. I don't know if that last bit was English. Sounded like awkward words, but hopefully you get the point. We shouldn't spend more than $82,000 for this property if the rent is proper, is it correct, and if our gross rent multiplier that we're using as a comparison is accurate. And this is not going to be as accurate. This gross rent multiplier method is not going to be as accurate as this given method, because given includes vacancy and expenses, and that's nowhere to be found in all of this, right? Gross rent multiplier is, first of all, not to be used for large properties like multiple 100-unit apartment buildings, only for little single family, maybe condos, townhouses, just small properties, duplexes, but not major, huge projects. Just a rough idea, rough estimate. Property management firm can receive its income in any of the following ways except which one? There's a lot of except questions in this practice exam. They are certainly allowed to accept it as a fixed fee. They can certainly get it as a percentage. They can also get it as a fixed fee, so they have a base amount, and then also a percentage bonus on new stuff. Let me get incentivized for what I bring in, but I know I'm going to at least make this much. What they won't get paid by is as a percentage of purchases made from suppliers. That sounds a little bit like a kickback, right? Made from suppliers, that's just not related to the client, not related to the renter so much. So it could be a fixed fee or it could be a percentage of rent. That's pretty much the way property management firm would receive income. Best definition of actual eviction. They used some fancy words here. The right of a landlord to use the rental premises. No, this isn't that same one. No, that's not eviction. Actual eviction is really two words that don't even have the word eviction in them. What is actual eviction when you need to kick a renter out through the court system? What is that called? It's not called eviction. There's a different word. It's two words, some kind of something. Doesn't have the word eviction in it. We learned about 4 different kinds of eviction in the property management landlord-tenant chapters. Yeah. It's called, the legal term, summary ejectment, right? So the enforcement of a court order to remove a leaseor, what's wrong with that one? The leaseor is the owner. So we're not removing the owner, we're removing the tenant. If only there was an answer choice that had leasee instead of leaseor. The landlord's future interest in the rental property premises, no, that's not eviction. The enforcement of a court order to remove a leasee, oh, well, what do you know? There it is. So hopefully that logic, right, just going down through the answers kind of helps. Just break it down. A leasee, and this is the importance of knowing the word, is it the one renting or the one to whom the rent is paid? In this case, it's the renter, pays some or all of the leaseor's property expenses. What kind of lease is that? If we're talking about paying expenses, it's net. Because you can remember that with the given acronym. When you take expenses out, you end up with net. Therefore, when the rent involves expenses, it's a net lease. Maybe that's a good way to remember it. What is it when it's a percentage lease? What is a percentage lease composed of? Has nothing to do with expenses. What does it have to do with? A percentage lease, highly testable item here. Write this one down. Percentage lease is based on I think about mob movies, mafia movies, right? When they go into the little store, mom and pop store, and they break somebody's thumb and they say, you know, we don't want this to happen to you by somebody else. You need to pay us a protection fee. Pay us a percentage of what you made this week so that we can protect and make sure the place doesn't burn down. I know I'm a little dark sometimes, but I like those movies. So think maybe that's a good way to remember it. A percentage of your income or a percentage of your profit. That's what a percentage lease is based on. So it could be straight up percentage of the profit, Or it could be a base rent, words, plus a percentage. It could be a combination. And I think I'd probably like that base. I like to know I'm going to at least get this amount, but then I could also be incentivized for whatever I happen to bring in that month too. A sublease is something that you, the tenant, would do to lease to another person. If you don't need it anymore and the lease allows you to, you can sublet or sublease to someone else. The property manager is still over you, but you're subleasing to another person. Gross lease is everything included. An estate at will, oh boy. We covered that real quick because it's pretty basic. All that really means it's a friendly kind of lease. An estate at will, we're happy about it. It's casual. It's informal. The landlord can say, you need to get on out of here. And no hard feelings. The tenant can say, I'm going to be gone tomorrow. And the landlord's like, what? No, the landlord's going to be, oh, okay, that's fine. Because it was an estate at will. It's a type of leasehold estate. We're talking about rentals here. So it cannot be terminated. That's not true. It can be terminated very easily, the easiest of all of them. It can be terminated only if so stated in the last will and testament. That's nonsense. Terminates on the date specified in the lease agreement. Well, there probably isn't one. Terminates on the death of the leaseor or leasee. That's the best answer because it's super informal. And it could also just be because they changed their mind or they don't need it. Again, you're looking for the best possible answer. That one looks pretty simple. We'll skip that one. Lead-based paint can be kind of tricky sounding. HUD, Housing and Urban Development, requires that for lead-based paint properties, we're talking about things built before 78. So this answer choice A, even though it's not the right one, gives us a little factoid that's useful. It does not, though, we're not required, owners are not required to test. They don't have to test. But if they did test, they need to share the results. If they know that there is lead-based paint or not, because of a test result, they need to share it. They need to disclose it, but they're not required to do the test. Certainly not required that the paint's removed from surfaces before selling. That would be your disaster. And then it's not required that only licensed contractors engage in the removal of any lead-based paint. The owner could do it, right? The owner's allowed to do it, but if they hire a contractor, that contractor has to follow certain guidelines to handle the lead-based. First of all, they have to test. If it's a contractor you're hiring to do work on a property built before 78, that contractor needs to test to see if there's lead-based paint so they'll know how to handle the safety guidelines. Do they need to wear the hazmat suit, the big yellow suit, the mask, the ventilation, the breather? We talked about this past week. When you're trying to scare, when a dirty, terrible broker is trying to scare a seller by saying so-and-so might be moving in here, it's going to lower values, you better hurry up and sell. We're talking about manipulating a seller with this nonsense. That's called blockbusting. Which one is it? Well, there's only one other one. They don't give us good other answers. Steering is trying to manipulate and scare a buyer. You're saying you need to live over here, not over there, because they live over there. Farming a neighborhood is okay. Nothing wrong with doing that, except don't put your postcards into post boxes. Don't put them in the mailbox by hand. That's a federal offense. But we don't need to worry about that. Legal as long as it's true is certainly not okay. Federal fair housing laws may provide exemptions for all the following, except there are retirement communities that are allowed. That is an allowable exemption, 55 and older, 62 and older. And they have rules about it. It could be one of the two spouses must be 65 or 55 or 62. Private clubs are allowed. You could say only people who want to pay the dues can belong to this private club. And religious organizations are allowed to discriminate on the basis of religion. Let's say it that way. They can't discriminate on the other classes. Like, you can't say we are a Jewish organization, therefore you're not of the right national origin. No, they can't discriminate on anything except the religion. They're exempt, and they can say only those of this religion, but that doesn't give them a free pass to discriminate on the other categories. And certainly no exemptions for racially based organizations. That goes all the way back to the mid-1800s after the Civil War. I believe it was 1865 was the original the result of the civil rights. I forgot the full name of that legislation. Basically said no discrimination in both real and personal property based on race, right? Then fast forward 102 years, and the housing-related version, the Federal Fair Housing Act, was created, which said, I think, race, color, I believe religion. I'll have to look back. I should know these things. You need to know these things. It was 4 of them. And then it was 65, and then fast forward into the 70s, they added sex. In the 80s, they added handicap. I need to look back at it. We'll do that next time. And then I believe that was it. That brought us up to the 7. And then most recently, this year actually, the Realtor Association, the National Association of Realtors, said, we're not going to call it handicap anymore. We're going to refer to them as disabled properly. Thank you. Thank you in the chat. Race, religion, color, and nationality. That makes sense. So 3 of those are pretty much kind of related to each other: race, color, nationality, and then also religion were the original 4. Appreciate that. When a lender is trying to make a loan or not make a loan in certain areas, then that is the one called redlining. Their idea is they're drawing a red line around a map. Not allowed. Federal fair housing is indeed federal. That means the whole country. That means all the states. That one should have been pretty simple. Civil Rights Act of 1866. There we go. Prohibits discrimination based on a person's race. The very first one, this is not housing related. This is just everything related, right? As right after the Civil War ended, race out of this list. Do not call laws and rules. What are the do not call rules? Can you call somebody that's on the do not call registry? Can you, as a broker, call somebody, not looking at this question yet, on the registry itself? Yes, you can. And here's the rules, right? The rules are, if it's a past client, someone with whom you did a transaction, then you can still call them even if they're on the do not call registry for 18 months after the transaction is over. So yes, you can call people on the registry as long as they're either a past client. You can call them, keep calling them for 18 months. Now, caveat, that's the testable thing. In real life, it's like, are they going to turn you in and be mad at you for calling them? Probably not, because you've probably kind of become friendly with them. But we're just talking about what is a violation of the do not call registry, calling people on it outside of that 18-month window if you had a transaction with them. That to me feels more like, oh, I sold them a vacuum cleaner or some Tupperware. But when you're selling a house, you probably kind of almost become part of the family. So in real life, it just sort of not a big deal. But you need to know the test for test purposes of the do not call list. The other one is if they make an inquiry. If they make an inquiry on your website, for instance, they plug in their contact info to find out the price of a listing. How long are you allowed to stay in touch, keep calling them, even if they're on the do not call list, if they have made an inquiry on your website? Tell me in the chat. answers? Anyone? Anyone? Don't have it for me? Three months. 3 months, you can still contact somebody on the Do Not Call registry after they having made an inquiry on your website, for instance. And then 30 days, you have to make sure that your list that you're using to call people on the Do Not Call list to avoid, right? Who is on the DNC list, make sure it's current within the last 30 days. Make sure it's scrubbed list as of the last 30. You don't want one that's more than 30 days old. And it's not a good enough excuse to say, oh, I'm sorry, I didn't mean to call them. My list is 6 months old. That's not going to do it. It's got to be a 30-day-old or less list. So, a phone call from a licensee to which the following people are registered on the Do Not Call registry will be a violation of the laws. Which of the following is a violation? An expired MLS listing with another firm, obviously, is the right answer checked. What about a seller client closed 1 year ago? For sale by owner about your buyer's interest in the property, that's okay because your buyer legitimately has an interest in buying it and they are legitimately trying to sell it. Even if that FSBO is on the Do Not Call registry, you're allowed to call them if you really have a buyer. But too many agents lie about it. They don't really have a buyer. A home inspector about a property inspection, that's kind of they're not trying to sell a property inspection. They're trying to schedule a property inspection is probably what they're talking about there. Back to the Unit 17 valuation chapter. Market price versus market value. Value was the thing that an appraiser gives, right? They tell what they think it's going to sell for. We as brokers have to call it not value, but probable sale price. So then market price is what it actually did sell for. It has the word price in it. And we use the word sale price a lot. So market price, sale price, kind of the same thing. It's not C because the gross rent multiplier divided by value is not the right direction. It'd be the value divided by the gross rent multiplier equals the rent. And then probable sales price of the property is not right because it hasn't sold yet. The market price is something that has actually sold. That's what a comparable has. The price a comparable sold for is the market price. The market value is not something that you would use to describe the comparable because the comparable is definitely something that's sold. We know what it got. We would use market value to describe the subject property because that's the one that the appraiser is trying to figure out the value of. And then land minus depreciation plus land, that would be the cost approach to determining the market value, right? Again, market value is the thing we're estimating. Market price is what they actually got. Know that those different kinds of valuation or figuring out what something should sell for apply to certain things, certain kinds of property. So a resale residence is something you would use the CMA or the market approach, sales comparison approach, to determine. An apartment building, what would you use to determine the value of an apartment building? Which of the three? Cost approach, sales comparison approach, or income approach for determining what an apartment building should be worth? Yeah, good one. Income. Yeah, because it's making an income, hopefully. A retail location would be another income approach, right? Because that's commercial. And they're making income. That owner of that property is making income. And then it's more important what the income is than what the similar store down the street sold for, right? the bottom line of the financial statement is kind of something that appraiser is going to look at. And then a new residence, I think the reason the resale is better answered than the new is the resale is better to compare with other resales. In real life, yes, you're going to look at resales that have sold and figure out what the new construction is worth from that, but you would have to adjust for the fact that it's new versus those resale comparables because it's used. The resales are used. So the new one is probably going to have a premium on it. It's probably going to be worth more. Every year, new construction property sells for more money, for less. You're getting less for more. You're paying more and getting less. The lots are smaller by even just a little bit. The square footage is less because the costs just go up. So best answer here is resale because you compare the best thing to compare to are other resale properties. That cost approach involves depreciation. It involves setting aside the land value because you can't factor in the depreciation from what the land is worth because land doesn't depreciate. So calculating a dollar value for depreciation, when you see the word depreciation, think cost approach. It's the only one that has it. Those other two methods, we don't worry about depreciation. Sales comparison is about comparing things that have sold. We're not factoring into the mix of that depreciation of any kind. Income approach, gross rent multiplier is both about income, rental property. Cost approach is for what kind of property? What are we using, or what is the appraiser using the cost approach to figure the value with? What type of property is the cost approach best used for determining the value of? Cost approach for very unique properties that don't sell very often. So they're not quite income producing. They're not like single family residential condos or townhouses. What's left out there in the world? If you drive through any given town, you're going to be driving by neighborhoods of houses. You're going to be driving by commercial. Commercial would be the income approach, right? Because all of those, that Belk store has an owner that leases that building to Belk Corporation. I doubt Belk owns it. McDonald's probably owns their building. That's kind of what they do. They're sort of a real estate company that sells hamburgers. But the income approach applies to pretty much all of the commercial sector. That leaves the unique properties that Carrie's talking about. Yep, churches, government buildings no longer needed. Maybe they're vacant now. They've been moved out of old post offices, government buildings, schools, churches, things like that. Special use. The cost approach is for special use buildings. We can't use the sales comparison method because there's not like a bunch of those comparables nearby that sold recently to use to figure out the value with. And even if there were, there's no way they would be of similar size and type. It'd be like apples and oranges, right? So cost approach is unique. And the other nuance about cost approach is you have to figure out what it would cost to build that thing new and then subtract out for the fact that it's not new. And that's called depreciation. It needs paint. It needs repair. It needs an updated heating and air system, things like that. You need to subtract out for those problems for that depreciation and then add the land value back to that depreciated number. So that cost approach ends up being probably the highest estimate of value out of the three. If an appraiser does three, they might do the sales comparison method and also the income approach because it's a rental property, and then also the cost approach for some reason. If they did all of those things, the one that's going to come in the highest dollar amount is the cost approach, but that's not necessarily going to be the one that you can rely on. You need to think, what kind of property is it? And then give more weight to the approach that fits that type of property. So if it is a school building, government building, church, then yes, the cost approach value estimate is going to be the better one, more accurate one. If it's a rental property of any sort, whether it's apartment building, an office complex, a single family, one little house, a duplex, income is being generated, then use the income approach and use the estimate of value that came from that approach. That should get more weight. Or if it's a regular single family or land type, or condos or townhouses like primary residence for living there, not renting, then use the sales comparison approach. And that method of valuation is the best. This next question goes way back in the early days. All the following are characteristics of value. Well, scarcity affects value because the less of something there is, the more worth those things that are available will be, like a seller's market. Transferability affects value. We learned about that. How easy is it to sell that thing? If it's got problems because of title clouds, because of encroachments, encumbrances, because of zoning issues, it's hard to sell it, hard to buy it, then, or maybe it's a weird shape, transferability definitely affects value. Utility affects value because what can you do with it? If the buyer can't do with it what they want, then they don't give it as much value. They're not willing to pay as much for it. So a buyer who wants to work from home is not going to be willing to pay the price for a house in a neighborhood that won't let them operate a business from home. Obsolescence is not about a characteristic of value. Obsolescence has to do with that cost approach and calculating the depreciated value of a unique property. Those other three are characteristics of value. Obsolescence is something that negatively affects the property when we're calculating an estimate based on the cost approach. Connor Act. What's the difference between the Connor Act and the oh shoot, I just lost it. Is it back here? Connor Act and the, I'll think of it in a minute. What is the Connor Act? Tell me that in the chat. Statute of Frauds was the other thing. Connor Act versus Statute of Frauds. What's the Connor Act? Got it. Must be recorded to protect against third party, against people coming in and saying, oh, I own it. No, you don't. It's been recorded. The statute of frauds says it must be in writing to be enforceable. Those two things kind of are related because in order to record something, it needs to be in writing, right? So, but some things fall under the statute of frauds, some things fall under the Connor Act. In this case, all of the following must be recorded to be valid against third parties, except which one? Which documents get recorded in the natural real estate cycle? A lease for more than 3 years. We saw that weird little rule. We learned that leases, not 3 years or more, but for more than 3 years, don't have the automatic protection built in that keeps a tenant from getting kicked out in the event a new owner takes over. But if it's a lease for more than 3 years and it gets recorded, it protects that tenant. So therefore, those types of leases of that duration need to be recorded to keep that protection in place for the tenant. That's the Connor Act. A lease for more than 3 years applies because what we're looking for to answer the test question is which one is not a Connor Act thing. A deed of trust, also known as a mortgage, right? In North Carolina, it's a deed of trust. It's the thing that does what? What does the deed of trust / mortgage do? What does that document exist for? Purpose of the deed of trust is to do what? Deed of trust definitely gets recorded. And remember, there's the deed of trust and there's also the promissory note. Promissory note outlines the terms of the loan, but the deed of trust does what? Yeah, come on, in the chat. Give me a guess. The mortgage or deed of trust is the document that says my house is going to be collateral for my promise to repay this loan. If I don't repay, I'm going to agree in writing up front with this deed of trust that you can take my house from me. Yeah. It's pledging the property as collateral. It's what that deed of trust does, and that gets recorded. You can look up the deeds of trust of your friends and family and neighbors. Restrictive covenants need to be recorded under the Connor Act. Restrictive covenants, things that say what you can do with your property, because if you live in this neighborhood, you have to abide by these restrictive covenants. How do you find them? They're recorded. What does not get recorded? A contract. If you think about it, right? You're not recording a contract. You're recording things that came as the result of the contract, because the contract informs the deed. The attorney's going to use the contract information to write the deed. And then the thing that's not in this list of those remaining three things that are things that are recorded is the deed. The deed gets recorded too. The deed of trust, leases for more than 3 years, restrictive covenants, all of which get recorded, but the contract does not. An offer to purchase does not get recorded. A listing agreement does not get recorded. A buyer agency agreement does not get recorded. Which of the following is true regarding a special warranty deed? Okay. How do we own something? What kind of deed? Well, we've talked about types of estates. Fee simple absolute, fee simple defeasible, life estates. That's related to what the owner tells you can do with it. The type of deed is related to what the owner is promising to give you as support. The owner is saying, look, I've owned this, and if it's a general warranty deed, that's the best kind, and it says, look, I'm swearing that I own it. I'm swearing that I promise I will do all I can to help you clear up any clouds if they come about, because I swear that anything that happened while I owned it and before and in the future, I'm going to stand behind and help you make it right. That's a general warranty deed. 5 covenants of warranty or protection. Covenant of Seisin, S-E-I-S-I-N. That's the one that's kind of weird. It's like from the medieval times, and it's basically like two people dressed funny looking across the hills and saying, look, that's what I'm selling you from all the way from over there to over there. You can't see me, I'm pointing. All the way from over there to over there. That covenant of Seisin says that's what you're getting when you buy it from me. And then there's 4 more covenants. Quiet enjoyment is another one. You can do with it what you want, right? Free of the lender's not going to come in and barge in all of a sudden. Covenant of quiet enjoyment. So in this case, they're talking about special warranty deed. General warranty is the best. It's got 5 covenants. Special is the next best. It only has 2. And it pretty much says, look, I'm the one I'm selling it to you. I'm not giving you a general warranty deed. I'm giving you a special warranty deed because I will just stand behind it for the time I owned it. I'm not going to stand behind it before I owned it. I'm not going to give you any extra stuff besides, hey, while I had it, I didn't do anything wrong. I didn't set it up for some third party person to come in and say that they own partial part of it. I will swear by the amount of time that I was the owner. So a special warranty deed, A, is not right because it's not additional warranties beyond the general. It's less than the warranties given in a general warranty deed. And then grantor retains an ownership interest. No, that's not the case. The seller is gone. They're done. They have no ownership interest in the property. A grantor is warranting no undisclosed encumbrances exist. That's not right. The grantor's warranties are limited to the time the grantor owned it. They're just swearing to the time they owned it. That's the definition of a special warranty deed, which, by the way, is the kind of deed that you're going to get if you buy a bank foreclosure. The bank's never going to give you a general warranty deed. They're not going to swear by, think about it, they're like a corporate structure, a corporate entity. They're saying, hey, we're not going to give you more than we absolutely have to. Therefore, we can just promise that while we had it, nothing went wrong, nothing went crazy. We'll give you a special warranty deed, not a general warranty deed. For a deed to be valid, which of these applies? The grantor has to be competent. Yeah, we know that. The signature of the grantor must be witnessed. While it probably is going to be witnessed because you're doing it at a closing and the attorney is going to witness it, but that's not something that makes it valid or not. Be careful with the things that make it for a valid deed. Essential elements of a deed have nothing to do with, it doesn't mean that these things have to be done. The essential elements have to be done, but there are non-essential elements that are done, but they are not, just because they weren't maybe done doesn't affect the validity of it. That's what I'm trying to say there. The deed must be recorded. That's not an essential element. It's a good idea, and in North Carolina it's going to happen, but it doesn't affect the validity of the deed. It's still a valid deed even if it weren't recorded. It's just that if it's not recorded, you don't protect against third-party claims. So just that's the difference between essential and non-essential. It's still a valid deed even if those non-essential elements are not included, not part of it. A grantee must sign the deed. Well, that's not true because it's not the receiver, it's the giver of the deed that has to sign it. Don't forget, only the seller, only the grantor signs the deed, right? So that's not even true, period, at all. The grantor must be legally competent, though. Otherwise, it wouldn't be a valid deed. It would be what kind of deed would it become? What other V word would it be if the parties are not legally competent? Not valid, but voidable. Problem with the people, right? Not 18, not sane, not sober. One or all of them. One or two or three of them, right? With that said, we will do whichever questions you want to do. Let's go ahead and call it Saturday. I'll send you out by email an invitation to, well, yeah, I'll do that, but I don't think I have to. I'll have the room open, but I'll just do that anyway. But it'll be available from 10, starting at 10. We'll be shooting for like 10 to 12. We'll do that. It's dedicated to math, but if we run out of math stuff to work on and you have other questions, I'm happy to talk about them. And that's on Saturday, this coming Saturday. But for next week, for next Wednesday, go through those questions, those test questions, any other questions, and we're just going to keep marching through. We'll talk about agency, we'll talk about contracts, and any other high dollar productive activity, right? The greatest chance of test questions coming, those topics, and then anything else you have. So we'll make it your own. So let me know what I can do to help. Put your name in the chat for me, and I'll hope to see you on Saturday, but definitely by Wednesday. Yes, that math review, I will live stream it, and it'll be available at the YouTube channel, askneilpender.com.